I'm Ben Reppond. Welcome to my YouTube broadcast. Today is Wednesday, September 27, 2023. I'm going to begin with, I played this yesterday, so if you watch yesterday's video, this is a repeat. The piece I'm going to play are some excerpts from an interview that David Rubenstein did with Jeremy Grantham, and it's so well done. There's so much material, and he's so credible. He has predicted correctly 3 bubbles. I think he's actually predicted 4. So he predicted the 2000 tech bubble crash, the bubble meaning in 99, the crash meaning 2000 and after, the housing bubble, which was building from 2005 to 2007, but the crash happened in 2008. And then most recently, the bubble in 2021, which resulted in a significant stock market and bond market decline in 2022. I think the other one he predicted was, and I can't say this for sure, but I believe it's correct, was in 1979 to 81. He's 84 years old, so he could have done that. And so I believe he did. And so he's a student of bubbles, going back, of course, to the Great Depression, and then the 73, 74 bubble, 79, etc. And so here he is predicting that we are the asset prices are going to decline now as part of the bubble that occurred in 2021. So in the for the years up to 1921, you would say that was a bubble that was building. That's what he called. And then when 2022 happened, he was validated. And what he's saying now is, following that crash, I won't call it really a crash, but a significant decline, that asset prices will deflate. And what that means is real estate and stock market and probably bond market will be coming down in the next year, according to Grantham. So anyway, here's this piece from him. Apologies if you watched the video yesterday. It's a repeat, but I want to give this as the kind of the central thing that I can show as a clip for today. And then from here, I'll get into the dashboard and charts.
Throughout his 5+ decades managing money, Jeremy Grantham has earned a reputation as a bit of a doomsday oracle. The billionaire co-founder of GMO has become famous for predicting financial disaster, most notably by identifying investing bubbles before they pop, like the dot-com crash in 2000, the financial crisis in 2008, and the tech bubble in 2021.
Once in a blue moon every 20 years or so, we'll hit an inflection point that people stop thinking about fundamentals and they just start worrying about how much the stock is going up and are they missing it.
And now, Grantham is confident about how things will play out next.
We will have a recession running perhaps deep into next year and an accompanying decline in stock prices.
You are well known in the investment world for saying that sometimes there are bubbles and bubbles should be avoided. Do you think we're in a major bubble now, right now in the United States? And do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe...
It may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. they have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down. And we're now in an era that will average higher rates than we had for the last 10 years.
So today, you would say we're likely to go into a recession probably next year, though it could start this year, that the tech bubble burst that we saw beginning, let's say, last year has not yet completely played itself out.
Right.
And we have a little mini bubble a bit in artificial intelligence.
In a way, not so many. They were very big moves in a dozen very big stocks. And
well, mini in the sense that it's not affecting the overall economy as much as the whole tech
No, that's
world
right.
did.
In comparison to 2021 and 1929, it's much
So
smaller.
what is it about human nature that makes them feel they want to participate in a bubble? They see the stock market going up and they think they're going to miss something. Even the famous Sir Isaac Newton participated in a bubble.
Yes, he did.
When he thought he was missing something. He mortgaged his house and put all of his money into the South Sea Corporation and lost all of his money. So even somebody as smart as that was unable to resist the bubble. Why is it that humans can't resist being in bubbles?
I always like to say there's nothing more supremely irritating than watching your neighbors get rich. It is just irresistible to try and join in. And when enough people hit the inflection point, it sucks in everybody. And they're the great bubbles. They're the ones that are interesting. Mostly there's a nice balance between bulls and bears. And once in a blue moon, every 20 years or so, you'll hit an inflection point where enough people become bullish that people stop thinking about fundamentals. I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be.
Okay, the first dashboard is, this is the stock market. This is pretty interesting. So you've got the yellow box has got, last week, look at the decline in all of the indexes. These include the 4 U.S. indexes, Dow, S&P, NASDAQ 100, and Russell 2000, and the 2 foreign indexes, emerging markets and developed markets. And at the very bottom, the 20-year government bond. The government bond is the only one that's down for the year. The others are either up slightly or technology and consumer discretionary have, they've done better. And then the other indexes are slightly positive. Bonds have, we'll look at the chart on it later, just been crushed, and they just keep declining. Why? Interest rates are going up. And so I've been talking about this for a couple of years. So if you've been hearing me pound the table on interest rates are going up, bond prices are coming down, they're still going down and are now down 40, 50%, depending on the bond, depending on the time you measure. And there are 3 positive dots, green dots, which show that the market is, those indexes are positive above their moving averages. Those 3 are above their 200-day, and all of the indexes are below their 20, 50, and 100-day moving averages. The sectors, when you take the S&P 500 and break it down into its 11 sectors, this is what that looks like. 4 green dots out of 44. 4 out of 44. It basically tells a picture. You just kind of count the dots on the right and it tells you the story. And then in the yellow box, you can see all of the sectors were negative. some of them down significantly. The one down the most was consumer discretionary. But, technology and consumer discretionary were the darlings the first part of this year. Now they're coming down the furthest. They were also the ones that were the worst performers last year. But here we've got 6 sectors that are negative for the year and 3 of them that are barely positive. We only have 2 out of 11 sectors that are definitely significantly positive for the year. So not a good picture. And so if you hear people talk about zombie companies or zombie stocks, the market the S&P is full of them. This is an example of them. Yeah, there are some technology companies, Microsoft, Amazon, Apple, Nvidia, etc. You hear these being talked about as darlings, but those are coming down now. And the rest of the market, once you get underneath those big names, is not doing very well. Okay, the S&P 500, this is the chart, and this is an 18-month weekly chart. So it covers a period of 18 months, 1 move equals 1 week, and underneath that, or running through that data, that chart, is a 20-period moving average, 20 weekly periods. And the S&P 500 has broken below its 20-period moving average, and of course it's well below its 20-day moving average. The black line shows the long term from October to present. That long term there has been, it's going up in value, but there is a lot of up and down. It looks to me, and I don't like to predict the market, but I would just say from looking at chart patterns, this particular pattern through Friday tells me that it's probably got further down to go. It's just moving in a downward direction pretty quickly. This is a picture of the last 4 weeks. This is a daily chart, a candlestick chart, and this is through Friday. And since that time, the market's gone down further. But this shows you the direction of the S&P 500 for the last 4 weeks looked at on a daily basis. When you see a red candlestick, that refers to that it starts here, it opens at this price, and it finishes at this price. That's a declining market. The S&P 500 has 2 kinds of stocks in it. Growth stocks and value stocks. And when they separate those into indexes, SPY G is the growth stocks and SPY V are the value stocks. Those are put into ETFs, and those ETFs, I put them on a relative strength chart showing SPY G or growth stocks as a numerator, SPY V, the value stocks as a denominator, and then I plot this on a line and with a 20-period moving average. So you can see last year, which is right up the first half of the chart, last year value was in favor. So if it goes down, this favors value. If it goes up, it favors growth. Growth has been in favor, but not as much as value was in favor last year. So it is still in an upward trajectory, which favors growth at this point. Large cap and small cap, same thing, a relative strength chart showing with SPY, the S&P 500, as a numerator, IWM, the Russell 2000 small cap index ETF, as the denominator. And when it goes up, this favors SPY, or large companies. And when it goes down, it favors small companies. Last year, you can see it mostly just went up and down a lot, generally favoring small companies a little bit. This year, beginning in March, it took off, and you can see where it's gone. Definitely, large companies have been doing, in general, a lot better than smaller companies. This is what I talked about earlier with the long-term government bond. This is just a period of 24 months, but you can see, what's going on. If I went back further, it's the same story. It just keeps coming down. And it's down and going down further. and I don't know how far down it's going to go. At some point it will turn around, but I think they thought that at the end of the year, back around October, November. I think people were thinking, okay, we got that out of our system. It can't go down any further. Not really. It went up a little bit and then collapsed. Okay, the US dollar. The US dollar is up. You may think, well, the dollar is being eroded through inflation and the printing of money or the money in circulation. True. But when you look at the value of this is an ETF, UUP, and when you look at the value of the dollar, it is measured not in those terms, but it's measured relative to other currencies. So relative to other currencies, the most notable being the pound sterling, but also the euro and yen and so forth. And relative to those currencies, this is how it's doing. So if we were to put the euro or the pound sterling on here, you would see that they are in decline because they are relative to our currency. Gold is pretty static. Didn't go very much far this last week. It is generally in an upward trajectory for the past 11 months. Same with silver, except silver is more volatile. It goes up and down more. It had a good week, but you can see it's up and down. But in the past 11 months or so, generally a positive direction. This is a relative strength chart showing gold is a numerator, silver is a numerator, gold is a denominator. So when it goes up, it favors silver. When it goes down, it favors gold. So what it does mostly, up and down. So there is no pattern other than up and down. But it has not changed. Those relative to each other have not changed that much over the past year or so. Bitcoin was pretty flat this last week, and it is generally up this year. In our Bitcoin strategy, we are waiting for a big move up, which we think is going to happen, but it has not yet. So until then, we've picked up some gains earlier in the year, and right now, for quite a while, we've been sitting in money market funds, waiting for the next move up. And volatility. Volatility has gone from 13 to 17. Now, it may be, as of this recording, maybe even higher at this point, but as of Friday, it was up to 17. Definitely, you can see that as a spike up relative to the long-term chart. When it gets up above 24, that's where, higher risk starts to enter the market and called high volatility. Okay, Asbury Research does some charts. One of them is the Asbury Six. These are metrics. They measure, positive or negative for each of these indicators, and they are all negative. So not dissimilar from everything else we're seeing. If we went back to the first two dashboards with the red dots and so forth, it would pretty much mirror what we're talking about here. Okay, now we're going to look at the relative strength or relative performance of certain ETFs or asset classes relative to each other. So, stocks versus bonds. Bonds for the last week. Now, when I say bonds, I'm not talking about government bonds. This is the benchmark AGG. And they did better than stocks. Both were down, but stocks were down more. Last week, the last month, the last quarter, and that's what those last three columns represent. High volatility stocks, high beta, versus low volatility is doing better. And we saw earlier, large cap is doing better than small cap. Blue chips, the Dow is doing better than the broad market, the S&P 500, and value is doing better than growth for the last week, month, and quarter. Emerging markets is doing better than the U.S. market the last week, last month, the last quarter. And bonds, short-term bonds are doing better than long-term bonds. Okay, this chart is U.S. versus the world. So it's a relative strength. showing how is the U.S., meaning SPY, S&P 500, doing against the ETFs for each of these countries. And you can see mostly what's happening is that the Asia Pacific countries are doing quite well. The ones I noticed were Malaysia, Japan, India, China, Thailand, and the Pacific Rim Index and emerging markets. So, and then 3 countries from Europe. But the U.S. is disappearing from here quite a bit. Gold and silver. So this is spot price of gold is $19.29, approximately no change from the previous week, and that was no change from the previous week then. So the last 2 weeks, approximately no change in the spot price of gold. Silver had a gain, we saw this on the chart, a gain of 2.4% for last week, and up to 23.68 before you put the markup on top of it. And that has a gold-silver ratio, gold numerator, silver denominator of 81 to 1. Monster box of silver is up to $12,935, so that's up a little bit because the price of silver went up last week. Still down from the high I remember a few months ago of being over 14,000. So, but it seems that it's on its way back up. The markup is $2.19, and when you put that on top of the spot price, the price per round in a 500 round box of generic silver is $25.87. If it's a tube of 20, it's 50 cents higher, or $26.37. And I get these prices from my son, Preston. Well, it looks like the bears are in control right now. The bulls were dominating for the first several months of the year, and now it's switched to be more bearish and in a period of decline. I don't know how long it's going to last, but it seems that it's got some momentum right now, and so that I thought this was a good cartoon that depicted that. So thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.